Hi guys, today we're going to be chatting about chapter 1 in auditing notes. It's not a very detailed or very intense chapter, but it's an important chapter that we need to go through now. If you have not been able to come to the lecture, or if you are too scared to come onto campus, then you can watch this video and you should be able to gain all of the information that you need from this week's of lectures. In this chapter, what we're going to look at is we're going to be looking at what is an auditor. We're then going to look at the need for an auditor. We're going to look at the different types of engagements that an auditor can do. We want to then look at just briefly what is auditing like in South Africa, what are the regulators like, what is the professional status like, those types of things. And then we're going to move on to the all-important topic of the PI score. And then very importantly, we're going to deal with assertions, right? And assertions are very important because they color the way we look at the rest of auditing for the rest of the year and the rest of the semester. Okay, so what is an auditor? Just a bit of background on how auditors came about, right? So auditors were first people that were employed by farmers. The farm owners that had many farms, multiple farms, would employ an auditor to go out to all of his farms and listen to the farm managers or the farm hands that were running the farm, right? So the owner would ask the auditor to listen to the person that was running the farm on a day-to-day basis. Okay, and so what the auditor would then go out there and do is he would go out and listen to what this person was telling him. Okay, so he would listen to what the farm manager is telling him and then relay that message back to the owner of the farm. Okay, so that was where auditors came about. In the same way today, we as auditors listen to what management is telling us. We make judgments on whether the information that we're receiving from management is credible and true and fair, right? And then we disclose that information to the shareholders, to other stakeholders or other important people that are involved in the process. Okay, so that is our purpose as auditors today. It's a bit more complicated because we're not really dealing always with farms, right? So we're dealing with companies that apply IFRS, we deal with complex companies, and so, but that is where you find auditors have arisen as assurance providers, right? Now, we've got different types of auditors here. The first type of auditor, and the one that we know the best, and the one that most of you all will become, possibly at the end of your degree, is an external auditor. So an external auditor is an auditor that goes out to a company. At that company, he then looks at their financial statements, ensures that it's prepared in line with IFRS. You may use the standards provided by IRBA to do this, right? And he is always independent. He is not employed by management, and he should not be influenced by management. He does then, if all of these criteria are met, he will then offer a type of assurance that is what we call at a reasonable level. Okay, so he offers reasonable assurance. So that's the first type of auditor, external auditor, the one we all know. The next is an internal auditor. Now the difference between internal and external auditor is the external auditor is externally employed or independently employed, whereas the internal auditor works for the management of a company. Okay, so they may not be viewed as independent of the company because they work for the management of the company. The next thing is the external auditor is looking to make sure that financial statements fairly represent what has gone on during a given financial year. Okay, so they look for, is it honest, are the financial statements true? Whereas when you come to an internal auditor, it is totally the opposite. They're not looking for whether it's true or false. What they are looking for is generally efficiency and efficacy. Right? So they're looking to make sure that it's effective and it works. Okay, so they would look more at processes. They would look more at documents and see does the document work and does it work regularly. Okay, so that's what they're looking for, and they report back to management. Now, you might also say it in this way: internal auditors go out and look at different types of things that are happening in a company, and they want to ensure that it's meeting the needs of management. Okay, so that's what they're doing. They're trying to ensure that the company meets the needs of management. The next type of auditor we have are governmental auditors. Now, a very popular one is the Auditor General, which we all know about because he's always in the news giving people different types of audit reports, and so that's the Auditor General. We also have with the Auditor General people like SARS, so other governmental agencies, people like SARS, the Revenue Authority in South Africa. They also go out and they audit people to ensure that people are paying the accurate amount of tax. Okay, so those are governmental auditors. We then got a very specialist field of auditing called forensic auditing. Now, forensic auditing very different from external auditing, because in external auditing, when we're going out to our clients, we are unsure of whether there is an error, a misstatement, or fraud that has occurred at our client, right? We don't know. We're going to find that out. Whereas with the forensic auditor, he is going out to a company, he already knows that there is fraud there. He may know this already because it's already been externally audited, right? And so he goes out there knowing that there's fraud, knowing that there's theft, and his job is to quantify and qualify the fraud that has taken place. So you want him to tell you how much fraud and in what account balances has it taken place. Okay, so that's the slight difference between forensic and external auditing. Then with special purpose auditors, this is where they are people that do an audit that is slightly different to the normal type of audit that everyone does, right? So special purpose auditors, for example, would do an audit on performance. So you'll often find that a company has wants to ensure that its employees have performed at a specific level, so they will hire an auditor to come and review the performance of staff members, right? So that's, for example, a special purpose auditor. You also may find in South Africa we have a thing called BEE credits, right? BEE credits. And in order to get business done in South Africa, you must have some BEE credits, okay? Which means that there is someone that goes out from company to company and audits those BEE credits. That is considered a special purpose auditor. Okay. So why do we need auditors? Like I mentioned before, the main reason for why we need auditors is because we have, just like in our farmer example, we have someone that owns the farm, right? And then someone that manages the farm on a daily basis. Okay, the person that manages the farm on a daily basis does not own the farm. So he may not have the best interests of the owner at heart. In the same way, the owner may not have the best interests of the management of the farm at heart. And so the split between ownership and management is what we call the agency problem. Okay, so management is unable, or the owner is unable to be at the farm on a daily basis, so he creates an agent. What is an agent? An agent is someone that represents another person. Okay, is someone that represents another person. Now, the other person in that statement is what we normally call the principal. Okay, so we have an agency, a principal-agent relationship, where the owner is considered to be the principal or the person that owns something, and the manager is considered to be the agent. So the first reason why we need auditors is because of this agency problem, right? The split between management and ownership. Okay, and so when the owners are looking at financial statements and they have not been at the client for the entire year, or they have not been at their business for the entire year, they are unaware of whether these financial statements are telling the truth because they've not been there. They don't know what's happened. But yet management or the directors have been there on a daily basis, and they may be able to lie to the owners or shareholders of a business. So as a result, you need the auditor to come in, look at the financial statements and look at the underlying information, okay? And then the auditor will say to the shareholders, yes, this is true, or no, this is not true. Okay, so that is the purpose of the audit. That's why we need the auditor. Now, how does the case of the internal auditor affect this agency problem? Why are internal auditors not sufficient? Okay. Internal auditors do offer some comfort to the shareholders. Okay. They do offer some comfort because we hope as shareholders that the internal auditors are ethical enough to come and communicate if they feel that management is stealing the money of the shareholders. But we have to have external auditors, someone independent of the situation, to come in, right, and to verify what management is saying. Okay, so that's why internal auditors cannot meet the function of being the sole assurance providers. You have to have external auditors. Okay. The next thing is we use financial information such as financial statements, such as annual integrated reports. We use this type of financial information to make decisions. Okay, and we make decisions about the future based on the financial statements we have in our hands today. In order to make decisions about the future, we have to have confidence, we have to have credibility in the financial statements that are in our hands. Okay. And as a result, the auditor adds that reliability, that credibility to the financial information that we are holding in our hands. Okay. Now, why is it that we need to make decisions about the future? Why do we need the auditor to give us confidence? Okay, because without making decisions in the future, our economy would not survive. Right, the economy, the entire market system is based on people, individuals making decisions about the future. Right, and then many people hedge their bets against those decisions. You can think of it like this: when you're starting a new business, right, you are investing on day one to make money out on day two, right? Or to make an income on day two. You are, in a sense, on day one, you are making a decision that is going to affect the future. Okay? In the same way, that's a simplistic example, but the rest of the economy functions on that type of principle. Okay? The other thing is that the government actually requires or needs to know what is happening in the future, because in order to plan everything that's happening in the government sphere, without knowing having any certainty or stability about the future, they're really going to struggle to make decisions. Okay, for you and I. So the government also requires that. The next is, because they are using and because we are talking about very large firms, okay, we're talking about very big companies. So when we are talking about very big companies, there is an issue with accountability. Okay, and this is particularly the case in the government. So when the government is using money that is not theirs, right? So it's taxpayers' money. The government is using taxpayers' money. We need to know what has happened to that money. So we need some sort of accountability. When you're talking about a large public company, a public company has a lot of influence in its surrounding community, okay? And as a result, we need to know what is being done with the money that it has collected. And so we have this idea of accountability. Now, the auditor assists with accountability because he holds management to account by forcing management to tell the truth about what they did with the money. Okay, so let me say that again. The auditor forces management to tell the truth about what they did with shareholders or the public's money, right? They force management to tell the truth about that. And as a result, they hold them accountable. Okay. Because once the public reads or sees what management has done, they are able to either fire management or keep management in. So they hold them accountable. Okay, so the next I want to talk about different types of engagements. An engagement is simply a piece of work, a job, an agreement between two people or two juristic people, two companies. Okay, the first type of engagement is an assurance engagement. Now, that word assurance means that you are giving someone some comfort. You're giving the reader of this engagement, you're giving them some sort of confidence, you're giving them some sort of credibility, and that's what the word assurance means. It means to assure someone of something. So you, in daily English, you might say, I am sure that this topic will be tested in the exam. Okay, that is a type of assurance. You are saying, don't worry about it, I know that this will be tested. And so assurance engagement literally means a section of work in which you are giving someone a guarantee, or a guarantee is a strong word, but in which you are giving someone some sort of comfort on something. Okay, so we have assurance engagements. The first type of assurance engagement is what we call audit engagements. Now, you are very familiar, I'm hoping you are very familiar with an audit engagement. So with regard to an audit engagement, the auditor needs this thing called significant and appropriate audit evidence. Now that is a auditing term. It's auditing jargon, significant and appropriate. Actually, it's a defined term in the standards, right? And so once the auditor has achieved the significant and appropriate threshold, then the auditor can then give an opinion, right, on what the financial statements are saying. Now, this is important. I think many people miss this out. When you're dealing with auditing, you are auditing the financial statements to the standard of the IFRS, right? So the IFRS is the standard. The accounting is the standard. The accounting standards are what we want to see, but the way in which we audit them is dictated by the international standards on auditing, right? So there's two standards that we're using in auditing. We're using IFRS as well as ISA. Okay, so we use both of them because we're looking for and so that's why what you'll find is, in order for a student to be good at auditing, they have to also understand and be competent at accounting. Okay, and that's why they both go together. Right. In order to have a working audit engagement, you have to achieve the significant and appropriate evidence, and you have to get it, and you have to get that amount of information for the entire financial statements. Okay, and when you get that amount of information for the entire financial statements, you are able to then issue an opinion that has what we call reasonable assurance. We're going to get into reasonable assurance just now, but before then, let's talk about the next one, which is a review engagement. So with the review engagement, we are offering limited assurance. Remember, for audit engagements, we have reasonable assurance. For review engagements, we have limited assurance. Okay, a review engagement, unlike an audit, is only on a specific type of section or area of the financial statements. It does not need to be on all of the financial statements. It can be on a specific section of it. There are cases where it will be on the entire financial statements, but that's when, in a case where the company needs to be reviewed. Right? Sometimes what you will find is the company does not need to be reviewed, but only a specific part of the company, like revenue, like the revenue cycle, that needs to be reviewed. Okay, so both of these are considered, both audit as well as review engagements are considered to be assurance engagements, because at the end of it we are saying we believe the financial statements say this. Okay. Then we have non-assurance engagements. Now, non-assurance engagements is where the auditor is saying this is just doing the work that he's being told to do. He does not issue any opinion on anything. Right? So he's not giving anyone any assurance, any comfort. Okay, so that's what are non-assurance engagements. Now, if we look at the different types of assurance, okay, we have your audit right at the end, right? And notice how this is the level of assurance. It increases, right? So the level is going up this way. And so we have, what we have here is audit. And under audit, we say there's reasonable assurance. And when I'm issuing my opinion, I issue my opinion in a positive, with positive assertions. So I say, these financial statements clearly present. Okay, these financial statements clearly present. The statement, that type of statement is a blanket statement. It covers the entire financial statements. Okay, it covers all of the financial statements, things that I may have looked at and things that I may not have looked at. Remember, the auditor doesn't look at every single transaction. He looks at a sample of transactions. But with regard to an audit, when he issues his opinion, he says these financial statements present, even fairly present, even though he hasn't looked at every single transaction in the financial statements. Okay, so that's considered reasonable assurance. Then we have something called moderate or limited assurance, right? And that's what we are talking about, engagement reviews, review engagements at least. So with limited or moderate assurance, you're giving a negative statement, okay, as opposed to a positive statement. You're not saying these financial statements present fairly as you would under audit. You're saying, to my knowledge, from what I have looked at, I cannot find anything that tells me that there is fraud or error in the financial statements. Notice the difference. One says these financial statements fairly present what has happened in the company. The other one says, to my knowledge, there's nothing that has come to my knowledge that tells me that it does not fairly present. Right. So the one is limited. Under review, you're looking at a limited set of data. You're saying only from what I looked at, I can't find a problem. Right. To my knowledge, whatever I've looked at, there is no issue with it. But under audit, you are saying, I've looked at quite a lot of things and I got a feeling that there's no problems. Right? So there's a slight difference in statement between the positive assurance and a negative assurance that is given. Right? So if you have issues with that, note it down. If you don't understand what I've just said, note it down, and I will take questions during consultation times. Right? So you're going to come to my office and consult about that. So with agreed upon procedures, now we're moving down, we're moving away from higher levels of assurance to lower levels of assurance. There is little to no assurance given under agreed upon procedures. There's no assurance given. Instead, we are told, the management will come and tell you, I want you to do this type of work. Okay? All we do is the work that we are told to do. We do not add anything or minus anything or say anything extra, right, on what we are given. And once we have done the work, we simply issue them all the findings. So, for example, if management came to us and said, I want you to test a sample of revenue of sales. I want you to test a sample of sales. Right. What we will do is we'd go off as the auditor, we'd select the sample of sales, we'd test each and every sample, and then we would give them back those tests that we have completed, and we'd say, this is what we have found. And we leave it up to management to make a decision, okay, or to come to an opinion or to come to a conclusion. We don't, in the first two, so in audit and review, we as the auditor come to an opinion. But in the last one, we leave it to management to come to an opinion. Sorry, I meant second last. So the second last one here is where we don't issue any opinion. We leave it up to management to come to a conclusion. Now, a compilation is very rare with regard to an audit, especially in the Big Four, with regard to an audit firm. But a compilation is where we take all of the trial balance accounts and we compile it into a financial statements. Now, there's obviously no opinion given there. All we are doing is identifying and grouping information together. So this is a type, again, of non-assurance engagement, right? So compilation is a non-assurance engagement. Right, so now let's talk about the different levels of assurance. So if you look at the last slide, we spoke there about reasonable. So we had reasonable, we had moderate, we had no opinion, right? And then again, no opinion. So let's talk about the levels of assurance so that you get an understanding for what assurance is. So assurance, again, like I said, is when we are offering some sort of credibility, we are offering some sort of guarantee. I don't like the word guarantee, but let's use it for now. We offer some sort of guarantee to management, right? So like I said, the word guarantee is the wrong word, but we'll use it. Now, the level of work, as well as the level of risk assessment, as well as the level of audit fees, they all increase as the assurance increases. Okay, so as the level of assurance increases, the more work the auditor has to do, the more identification of risks the auditor has to do, the more the auditor will be allowed to charge. Okay, so this is the type of this is the levels of assurance. Now we have 4 levels. The first is absolute assurance. Now, absolute assurance is what I would call a guarantee, and that's why I said I want to move away from that word. So absolute assurance is when you certify or guarantee that there is no error in a set of financial statements. Now, that's silly to do because in order to make sure that there is no error in a set of financial statements, the auditor will have to look at each and every transaction that goes through the financial statements, each and every account, each and every line item, each and every grouping together when creating the financial statements, each and every sale, and it just doesn't make sense. It's not humanly possible for an auditor to give absolute assurance. Okay, so just like in economics, right? In economics, in second year and first year, you'd often find that there's an economic model, and yet that economic model has very little to no bearing on the real world, right? So what economists tend to do is they take the real world, they dumb it down, or they make it very simple, and then they create an economic model out of it. But you can't use that model in the real world. In the same way, assurance or absolute assurance is a theoretical thing. It only exists in textbooks. It's not a real thing. An auditor, no human can give absolute assurance on a financial set of financial statements. Okay, so it's purely theoretical. But now we move into reasonable assurance. Now this is not purely theoretical. Reasonable assurance can be offered by the auditor. Okay, and in reasonable assurance, what the auditor is saying or doing is that the auditor is telling someone, a reasonable person, when a reasonable person looks at these financial statements, they can see that there is no errors. Okay, so that's what reasonable assurance is. Then we chatted about limited assurance. Limited assurance is where I say only based on what I've looked, and that's where the word limited comes from. Remember, when we spoke about review engagements, we said only based on what I have looked at, I can't see a problem. That's limited. So you're limiting when you're mentioning your opinion, you're limiting it to what you have inspected, what you have audited. So a limited assurance is based only on what you've seen. Okay, and then obviously no assurance is, for example, the compilation of financial statements or agreed upon procedures. There's nothing there. Under reasonable assurance, I say it's still a high level of assurance. Okay, the auditor still has to do quite a lot of work, right? There is a very low chance that the opinion that the auditor gives is wrong, and the way the auditor discloses the opinion is in a positive form, right? So he says there is nothing wrong in these financial statements, right? But with limited assurance or moderate assurance, you say, based on what I have seen, I can't find anything wrong. Okay. So, so, so those are the differences between the two, the different types of assurances. Now, it's important for us as students. I think most of the students here are not really interested in assurance, and that's, we just want to know how to pass. Okay. With regard to that, auditing can be quite tricky if you don't know how to study for it. So when we're studying for auditing, we want to be able to attend our lectures and understand the lecture content. Okay. If we learn the textbook off by heart, or we read the standards and memorize them, or even if we just do our tutorials and memorize our tutorials, it does not guarantee that we will pass. Right? We have to understand, we have to get down to the spirit, I say, of the word. We have to understand what is the intention behind something before we answer a question. What would that help us with? That helps us to apply our skill in a situation that we are not familiar with. What you will find is, as a third year student, you will often get something in the test or exam that you have never seen before. Okay, you're going to get, I'm telling you, you're going to get a scenario that is confusing and you've never seen before. But if you understand and if you get the spirit or the underlying intention of the standard, and if you understand the underlying intention of the standard, you will be in a better position, okay, to actually expound or apply what you've learned to the scenario. Okay, so that's why I say you have to understand the spirit or the intention behind the words that you are reading. Okay, we want to be able in third year to apply. That is the most important thing. The next thing is, what you'll find is, all of the weeks that we're going to do in first semester and importantly in second semester. So in second semester, you can't throw out everything you've learned in first semester and think you're never going to see it again. It does carry forward, right? And you will be tested in second semester on things you did in first semester. All the weeks link together. Okay, so what I would suggest is that you sit down and mind map all of the weeks and where are the points of intersection, what can be integrated with what. Now you will notice in lectures, your lecturers will tell you this fits in nicely with that topic, this topic can be tested together with that topic, and those are the things you need to be taking note of and writing down, because that's what would be tested. Okay. Now, what you're going to find is that there are different types of procedures. You have the general procedures in auditing, the audit procedures, and then you have the more complex ones, and then you have the very difficult ones that very few students get. Now I'm calling that the generation of procedures. You need to be able to build yourself up from the basic or the general procedures all the way to the very complex procedures. Okay. Now, how do you do that? When you are generating the procedure, you need to be able to quote the standard or the paragraph or the citation, right? And you must be practicing under exam conditions. Now, it's not too difficult to do the standard, to quote the standard, and the reason why is because at third year level, you are taking your books into the exam. Okay? You are taking your textbooks into the exam. You're taking your standards into the exam. So you are able to actually look up and quote the paragraphs. Now, with regard to your tutorials, this is critically important, right? Your tutorials are very important to your passing. For each and every tutorial that you do, I expect that you are going to attempt the tutorial and then mark the tutorial. Okay. If you have not marked your tutorial, you will not get a tutorial credit. You have to attempt the tutorial and then mark the tutorial. And if you have not marked it, you will not get a tutorial credit. Okay, that's very important. The next thing is Why are we saying that reasonable assurance is the only achievable thing? Why can't we give absolute assurance? Right? No student has asked that question yet, but um, it's important for us to understand why we can't give absolute assurance. Now, I have created an acronym, and that acronym is called I've bet FIP. I've bet FIP. Now, I've bet FIP is broken up into these things, right? The first is, it is impossible for the auditor to get enough evidence to give absolute assurance. Okay? Because there's so much evidence that needs to be considered. Each and every transaction needs to be considered, okay, before you give absolute assurance. And so as a result, you can't expect the auditor to, in just a few months of the year, to look at each and every transaction that took place during the entire year. Okay, you got to understand, large companies have multiple employees, hundreds of employees, passing transactions every second of the day, right? And now you expect a small audit team to look at each and every transaction. It's just not possible. Okay, so the first one is, it's impossible to gather enough evidence. The next is the cost versus benefit. So if I say, for example, these reasonable, between 60 and 70% sure that there's no errors in these financial statements, right? It gives you a certain level of credibility. But then if I come and say, listen, I'm 100% sure that these financial statements are 100% guaranteed to not have an error or fraud, right? The value between getting a 70% assurance and 100% assurance is so minimum, is so small when compared to the amount of work, the amount of hours that need to be put in to get it from 70% assurance to 100%. Okay, so as a result, we say the benefit of doing this is much smaller. The benefit of getting 100% assurance is much smaller, is small when compared to the costs and the time involved of doing the extra work. Okay, so we say the benefit versus cost. The next is audit evidence. So the nature of audit evidence is that it requires the auditor to look into the evidence that has been gathered and come to a conclusion. So it's not, it doesn't force you to come to a conclusion. You have to interpret it. It suggests an answer, is what I'm saying there. Right? So it hints at an answer. It does not force you to come to an answer. And as a result, because of the nature of audit evidence, you find that it's likely that we may not be able to give absolute assurance. The next thing that I want to talk to you about is testing. So when we do sample testing is when you only look at one or two items in a population. So if you have 1,000 sales transactions that took place in a year, you will only look at 10, because there's no time to look at all 1,000. Right? And based on what you find in those 10, you will come to an opinion, you will come to a judgment on the entire 1,000. Okay. So as a result, this is the technique that auditors use, and because auditors don't look at every single cent in a financial statement, they are unable to give absolute assurance, but are able to give reasonable assurance. All right. The next thing is, in accounting, you will know that there are lots of estimates that are used. Okay, everything is an estimate. From useful life, you guys would have done PPE. A useful life of PPE is an estimate. Right? You don't actually know how long a given vehicle or a plant will last, but you estimate it might last 4 years. So as a result, in accounting, now that's one example, but there are multiple, right? In accounting, there's lots of estimates. There's lots of judgment calls that are made. And as a result, an auditor cannot give an opinion on a judgment call. You can't give an opinion on an estimate, because the very nature of an estimate is that we don't know what will happen. But this is the best estimate that we have. Okay. The next is internal control. Now, internal control are the things or the actions, the responsibilities, the activities that management puts in place in order to make sure that there's no errors in accounting, right? But the problem with internal control is that it does not look at each and every transaction. Number one, internal controls doesn't cover each and every transaction. Often it does transactions in batches. And the next thing is, if people within the internal control system collude together, so they speak to each other and they collude, they are able to break the system. So for example, if you have a situation where creditors clerk has to bring a document to the creditors manager for signature and approval, if the creditors clerk then communicates with the creditors manager and they both collude to steal the money, how will you find out? You won't be able to find out because the internal control has been broken. Okay. The next is that audit procedures are limited in what they do, and the reason for that is because when we do audit procedures, we are actually only coming after the event has happened. Right? We don't audit while the company is trading. We audit after the company has traded, and as a result, we only have persuasive evidence. We do not have definitive evidence. We can't get definitive evidence. So we are limited in terms of the procedures we can do, and that limitation means we cannot give absolute assurance. Now let's quickly look at the accounting profession in South Africa. So in South Africa, we expect that accountants or chartered accountants are highly skilled individuals that offer quality service for the public good. Okay, we have in the past been viewed as very ethical and very intellectual. And we have the code of conduct, which heightens or improves or makes people from outside the profession see us as ethical. Now, in the last few years, we've had issues with ethics, right? Accountants, chartered accountants, auditors have had issues with ethics. They have not been ethical. And as a result, this professional status has been somewhat diminished in South Africa. But we are working hard to improve it. Okay? Now, the professional bodies in South Africa, the very famous one, and all of you all are probably familiar with this, is SAICA, right? And so SAICA is the South African Institute of Chartered Accountants, right? It's the only organization in South Africa that allows its members to call themselves chartered accountants. We then also have the ACCA, which is an international, a British organization that allows people to call themselves accountants, right, or ACCA accountants. And then we have a thing called CIMA, which is mainly based on management or math accounting. The auditing bodies in South Africa, there's just one. We just have the IRBA. Okay, IRBA is mandated by government, so it was created by government, and IRBA has only connections with SAICA. So only people that are chartered accountants can become registered with IRBA. None of the other bodies can become registered with IRBA, but that may change in the future. Now, important things that you need to know. So all of these books that are, or all of these things that I've labeled here, you need to be able to flag them and you need to be able to label them and take them into the exam. So for example, this year we are going to be looking at things like the Companies Act, the Auditing Professions Act in second semester. We're going to be doing the code very shortly, right? The Code of Ethics. The IFAC code as well as the IRBA code are exactly the same as the Code of Professional Conduct, SAICA's Code of Professional Conduct. There are slight changes that we will point out to you, right? The international standards, we have the auditing standards, the review standards, any other assurance standards, and then we also have non-assurance standards that you need to apply. Now let's quickly look at the auditing triangle. Okay, the auditing triangle is made up of three people. Okay, We are made up of the directors or management, right? They are made up of the auditors and they are made up of the shareholders. Now, the shareholders are the owners of the company. The shareholders will appoint directors, so they give management the power. In return, management gives them financial statements. Okay? The shareholders then appoint the auditor. The auditor is supposed to intersect those financial statements and review them to make sure that they are that they fairly present, and then allow the shareholders to see it. Right? And between the directors and the shareholders, they have these things called assertions that need to be covered. Right? So assertions is basically a guarantee that management is giving to the shareholders. So, for example, you guys will know from last year, you may have the assertion of occurrence, meaning everything has occurred. It is validly occurred. Right? So what management is saying in the financial statements is, when I'm giving you the financial statements, all transactions have validly occurred. But the auditor intersects it and says, let me check that all transactions have validly occurred. Okay, so the assertions are what the auditor works with in order to make sure that the financial statements fairly present. Right. So next we want to talk about the all famous and very popular public interest score. Okay, public interest score you will find in your legislation, right, in the company regulations. And in the public interest score, we have a calculation that is made. Now, it's not a very hard calculation, but it's a calculation nonetheless. So in the public interest score, we have the average number of employees, right, that have to be taken into account. We also have 1 point for every million rand of turnover, 1 point for every third party liability, and 1 point for every individual who has shares or shares in some beneficial interest of the company. Okay, now let's think about that. First, let's look at the application. So if it's less than 100 points, we don't need to worry, it's a review engagement. If it's between 100 and less than 350, and they prepare their financial statements internally, then it requires a review. An audit. It requires an audit. But if they prepare their financial statements externally, then we only need to give them a review. If it's over 350, regardless of the way it's prepared, it's always an audit, because this is then considered to be a public company. So over 350 is considered to be a company in the public interest. Okay? So that's important. Now, when we're talking about, let's go back to the calculation. When we're talking about average employees, there are certain questions that we must tackle. The first is, how do you treat casual employees? Do you take casual employees into account, or do you not take casual employees into account? And the answer is, if a casual employee is employed for more than 3 months in a year, he needs to be taken into account. If it's for less than 3 months, he can be ignored. When we're talking about turnover, the question then is, do you take into account other types of income, such as finance income, such as rental income, when you're talking about turnover? And the answer is, we only take into account turnover from ordinary course of business. So if the business is not in the business model is not to earn interest, then we can't take that into account. When we talk about third party liability, how do you treat things like directors or shareholders' loans? They are not considered third parties because they are related to the company. Right. With regard to point 3, I just want you to start to think about how would you treat share options or people that buy portions of shares? Okay, we won't get into that now, but I want you to think about that. So we've got a small class example. Let's have a look. Which of the following determine if a public company should have an audit? Public interest score, and whether the financial statements are compiled by an independent accountant, the requirement of industry in which the company operates. What do you think? Now, this is a trick question because the answer is 4. None of these determine whether a company needs to have an audit. Why? Because it's a public company, and public companies always have audits. Okay, so you're already being told that it's a public company. Alright, so public companies are considered to be companies that are over 350 and they always have audits. Okay. So that brings us to the end of this video. In the next video, we are going to continue on with the introductory lectures. We're going to look at a few other topics and we're going to tackle the almighty assertions. Okay, bye guys, and I'll see you in the next video.